So, good morning, everyone, and welcome along to our latest economic and fiscal forecast discussion. I'm Graham Roy, I'm Chair of the Scottish Fiscal Commission. I'm joined by my colleagues Dominic Lombardi, who's Commissioner, and Francis Beaton as well. And we're also joined by some of the Fiscal Commission team. And we're on hand to talk you through a broad overview of our assessment of the latest economic and fiscal forecasts, but also to have a conversation with you about some of the issues that we think are important and pick up any questions that you have. The meeting is being recorded, so and we'll be able to post that and share that afterwards, and we'll be able to share any further questions or anything like that you have as well. The way we're going to do the questions is via Slido. So if you can log on to slido.com and then use that event code there, then you'll be able to load up any questions and also vote for any questions that you want us to respond to. And what we'll do is we'll try and get through as many questions as possible, but we'll prioritise the questions in terms of the ones that are the most popular, and we'll try and get around them as quickly as we can. Okay, so I'll probably try and talk for maybe around half an hour or so, slightly less than half an hour or so, just to give you a broad overview of our thinking, and then we'll move on to the questions there. Great. Okay, so what are the big things that we are thinking about, and what are the big things that we're looking at to determine our economic and fiscal forecasts? So as we were seeing in December, the big story in town remains inflation and the outlook for inflation, and that has a number of different impacts. It has an economic impact in terms of our assessment of the projections for the economy, but it also has an impact on day-to-day living standards, and also has an impact on government budgets too. And overall, the assessment for inflation, at least at a broad macroeconomic level, hasn't really changed since December. So we still think that inflation will fall sharply over the next few months from its peak of around about 11%. At the start of the year. It will fall quite sharply as we go through the remainder of this year, but it will take time for it to recover to around the 2% level, the target level. Now, the main reason for that fall is essentially the base effects. So to remember that inflation is essentially measuring the year-on-year change in prices. So clearly, if prices jump up, then that's a huge increase in inflation from that year to the next. But in the subsequent year afterwards, then unless prices are continuing to rise at that same jump up level, then inflation will flatten off. But it doesn't mean the price level has gone back to where it was. It just means that the inflation rate has slowed. And that's the broad expectations of where we think inflation will go over the coming months. Now, we will pick this up in the conversation. There are some questions about that assessment. So there are questions about whether inflation will fall even more sharply that and potentially enter negative territory towards the end of the year. There might be some aspects of price baskets that might enter negative territory. And then in other hand, there's questions about whether there might be some stickiness in inflation, and whether some of the effects we've seen in terms of prices and price rises might actually have some greater longevity in terms of that increasing the rate of prices. And that's obviously a live debate at the moment that the Bank of England and many other central banks are wrestling with about how to respond to interest rates with that evolving inflation picture. So overall, the inflation picture is broadly the same to what we were seeing back in December. What does that mean then for the economy? So broadly speaking, the big thing is the impact that will happen to living standards. So we still think that living standards will fall this year as a result of the sharp increase in prices. We don't think the fall will be as significant as we were forecasting back in December, but it will still be, the 2 years, last year and this year, where this energy price shock is fed through. It will still be the biggest fall in living standards that we've seen since the data started being published on this in the late 1990s. And even though that living standards should start to rise, so household income should start to rise next year, it will take time for those living standards to catch back up again with the negative shocks we've seen over the last couple of years. And it will probably be more around to 2026, 2027 before we start to say that living standards were higher than they were prior to this crisis, and that's essentially the legacy effect, the debilitating effect of inflation, in that it essentially erodes all our living standards. This here is median, so we're looking at the average here. Clearly, if you look across the income distribution, there are variations within that. So particularly, government policies from the UK government, Scottish government, prioritising those on the lower end of the income distribution. However, we also know that people in the lower end of the income distribution perhaps face higher price inflation because of the effects of food price inflation and energy price inflation too. So it'll take a bit of time to work out what the full effects of that are, but at least at a median level across the board, then we're going to see a significant drop in living standards, and that's particularly likely to be acute at the lower ends of the income distribution. In terms of what does this mean for the overall economic context, again, broadly speaking, our outlook hasn't really changed over the last 6 months since we made our forecasts in December. If you recall, back in December, we were projecting that essentially the next 2 to 3 years be a relatively fragile period of economic growth before starting to pick up toward the end of our forecast horizon. But we are thinking that there might be a slight technical recession through the tail end of last year into this year. But we were cautioning that wasn't really something too much to focus upon, largely because we were dealing with very small percentage point variations in very large numbers around overall economic activity. And that's broadly what we're seeing at the moment. So we're seeing relatively fragile growth in the last year. We've had a couple of very close to zero figures, actually one negative and then slightly more positive. And that's essentially the story that we think will continue for the remainder of the year. The slight uplift in outlook is broadly similar to the broad assessment that people have made about the global economic outlook. So across Europe, forecasts have been lifted ever so slightly, and across the UK as well, there's been a slight uplift in the forecasts. And that's driven by a number of different factors. It's driven by the perhaps slightly quicker response to diversifying in the energy mix and scaling back in consumption that perhaps didn't mean there was the same fallback that had been thought, but also the faster opening up of restrictions or easing of restrictions in China, which has helped provide a boost to the global economy and the freeing up of some of the supply chain blockages that we had seen post-COVID. And all these effects have slightly improved the global economic outlook. In that context, we're not really too different from the forecasts that exist from the other main institutions looking at Scotland in the UK. We are broadly in line with the OBR. I'll come back to that point in a second once you start to adjust for demographics. And broadly speaking, most people are projecting that the economy will have a relatively a steady recovery over the next few years, but it will lag behind long-term trends. And we don't really see too much evidence to suggest that Scotland is going to be significantly different in that context. So our forecast pretty much in line, relatively flat growth through this year, slightly faster growth next year, and then starting to pick up, moving towards what we think is going to be Scotland's longer-term trend of around 1.4% toward the end of the forecast period. And now you'll see there that we are forecasting that Scotland's economy will grow more slowly than the OBR are forecasting for the UK. But as I mentioned, one of the big drivers in that, and we talk about this quite a bit in our report and in previous reports, is demographics and the changing outlook for the totality of the workforce in Scotland relative to the UK. And when you start to adjust for that, then you see that these effects, the differences effects between Scotland and the UK are no longer as apparent. And just to illustrate that, just this chart here tries to make that point in comparing the Scottish and the UK growth rates. So the yellow line is essentially showing the performance between Scotland and the UK, so the relative difference there, in essentially the decade after the financial crisis up to the pre-pandemic period, so between 2010-11 and 2019-20. And the left-hand part of this chart here is essentially showing you the totality of GDP. The green line is essentially what we're forecasting for the next 5 years between 2022 and 2023 and 27 and 28. And the right-hand side is essentially showing the difference between GDP per person. So essentially adjusting the totality of the economy for the differences in demographics. And as you can see here, we're essentially assuming that the trend we've seen over the last, or predicting the trend we've seen over the last decade is likely going to continue for the next 5 years or so. So in short, the gap between Scotland and the rest of the UK, and the UK as a whole, in terms of totality of GDP, will be just over about 0.4 percentage points. Once you adjust for population, then that gap will be much smaller, down to about between 0.15 and 0.2 in terms of the growth gap. Now, a couple of reasons why that growth gap will still be there: differences in participation across different levels of the population, differences in sexual mix, which might feed through to productivity. But broadly speaking, we don't see a structural significant difference there on GDP per head. Now, that's maybe something we might come back to. So, some interesting questions in there about things like outlook for oil and gas and how that feed through to future productivity outcomes. And we had a really big discussion in this report this time about participation rates and differences between participation rates and rates of inactivity in Scotland and the rest of the UK. And at least we can start to see a slight divergence in rates of inactivity, at least in some of the data, between Scotland and the UK and participation, which is something we'll come back to. So I guess the core message on the economy is essentially no real major change to our assessment from where we were in December, a slightly more positive and optimistic outlook in the short term, and that a technical recession is likely to be avoided. But broadly speaking, we'll move back to where we were thinking that the economy would evolve toward the end of the forecast period. And that's relatively steady growth, but because of things like demographics and weak productivity growth, it will be lower than where it has been historically and prior to the financial crisis. So turning to the fiscal side of things and thinking about where we are on some of the key elements for that, if we can maybe turn to tax first of all, and spend a bit of time talking about the outlook for income tax, so the most important element of the Scottish Government's devolved taxes. And the good news is that we're forecasting about potentially £400 million of additional tax revenues coming in 2023, 2024. So our forecast back in December 2022 was about 15.8 billion. We now think that will be up to about 16.2 billion. And the main reason for that, some improvement outlooks on the economy. So in part linked to earnings forecasts and employment, but also linked to that slight improvement in overall economic activity in terms of GDP that we're talking about, but also some in-year data updates. So we've got new data coming through on RTI, which is slightly more positive than we had forecast. And that's in addition leading to an increase in income tax revenues that we project coming through to the Scottish budget. So that's all positive. But of course, we've got to remember that what's really important in the Scottish context, and the devolved Scottish budget context, isn't just the improvements that we might think are coming through to income tax revenues in Scotland, but potentially the improvements are coming through to our UK income tax receipts. And to the extent that they have exactly the same effects coming through, so a slightly better economic outlook, slightly better data, then essentially that will offset the improvement in the Scottish income tax revenues because the block grant adjustment will go up. So what really matters is the net tax position. So the difference between the income tax revenues that we project to be raised in Scotland versus the block grants, or the equivalent growth in tax receipts elsewhere in the rest of the UK. And as you know, we've been publishing now for the last few years our assessment of the net tax gap and where the net tax gap might be evolving and changing. And what we've got here is just the different net tax gaps we've published back to January 2021. And the most recent number there you see is the May 2023, so the orange or the yellow line there. So a couple of points just to take away, I think, that quite important for understanding the net tax position and what we're seeing here. So first of all, we have forecast up our estimates of income tax revenues, but we also think that the block grant adjustment will go up as well. So the net tax position is improving, but it's not improving perhaps by as much as you might think just by looking at the income tax data, because we're also thinking the block grant adjustment will improve as well. Net, though, we still think on our latest projections that you'll get the net tax position is slightly improved on our December forecast, and you can see that by the yellow line lying above the green line as we move through the forecast period. However, there's a couple of really important points I think that we need to understand about that. So first of all, we think one of the reasons why we're forecasting a slightly better net tax position than we had been, say, this time last year, is that some of the data we're seeing shows that the gap that had perhaps emerged over the last 5 years between earnings growth between Scotland and the rest of the UK, and Scotland's essentially share or comparison of earnings relative to the UK, which had been declining, has actually started to level off and potentially might catch back up again to an extent, and that helps to improve the net tax position. However, there is also a distant judgment call that is being made to some extent between the overall outlook for earnings between ourselves and the OBR. So we're forecasting that nominal earnings over the next 5 years will average growth of about 2.6% over the period. The OBR are more pessimistic than us. They're forecasting growth of only 2%. Now, if one of us happen to be having to revise our forecasts as we start to move through the next few years, so if we become more pessimistic or the OBR become more optimistic and move towards our forecast, then that net tax position will start to decline. It'll become less positive. Why? Because if the OBR uprate their forecasts for earnings, that will lead to higher our UK income tax receipts growth, and if we don't change our forecast, that will narrow the relative gap between what we're thinking will happen to income tax revenues and the BGA. So we've been quite clear to caution that there's a particular additional degree of uncertainty about these net tax positions as we move toward the end of the forecast period because of that divergence between ourselves and the OBR in terms of the overall outlook for earnings. A second thing that we're trying to pick up and help people understand is you see that the net tax positions here are moving around and have moved around quite a bit over the last few years. Now, a couple of points about that. So first of all, that's quite deliberate in a sense because the government has started to has introduced more tax policies to raise additional revenues, which in turn turns a more negative tax position into a more positive tax position. As I said, judgment calls that we're making about a divergence that had emerged between UK and Scottish earnings growth, perhaps not being as strong as it has been in the past. So again, that helps improve the net tax position in a Scottish context. And then finally, just that this is one of the things that as we go through add additional data points to the operation of Scotland's fiscal framework, we see that these net tax positions are just going to move around and they will vary year to year, simply because what you're dealing with is essentially the difference between two very large numbers. So 300 million, 500 million, 600 million sounds a lot, and it is a lot of money in the devolved Scottish budget context. But when you're talking about tax revenues of over 16,000 million, and in the UK context, even bigger than that, very small variations in tax performance will lead to tens of millions of pounds, potentially hundreds of millions of pounds variation in a net tax position. And to give you a rough rule of thumb, a 0.1 percentage point change in earnings in forecast for Scotland leads to about £25 million improvement in the net tax position. So very small variations on these very big numbers will make these net tax positions move around. I think one of the interesting reflections on that is that given that, and given the potential for variability and movement, is the fiscal framework got sufficient flexibilities to cope with that and to cope with that margin of forecast error when you have borrowing powers of 300 million and net tax positions are potentially moving around, or income tax forecasts are moving around quite a bit. And we discussed that a bit at committee yesterday when we were there. So that's the net tax position. The other thing on income tax that is worth highlighting is the potential for this very large negative reconciliation to come into the budget for next year. And we'll know the details of this in July when outturn data is finally published for 21-2022 in July this year. Now, if you recall what happened, and one of the key explanations for this is that back in the late 2020 and then early 2021, this was the point where COVID was particularly uncertain, and you had in late 2020 real fears of the Omicron variant coming through to the economy, additional shutdowns, and it had quite a significant change in the assessment of the outlook for the economy. It was quite negative at the time, and at that point, that's when the OBR made their forecast for the economy, and then therefore the implications for income tax revenues in the BGA. Jump forward a couple of months when the Scottish Fiscal Commission were doing their forecasts in early 2021, the outlook was more positive. The vaccine rollout was on the way, and the assessment of the overall outlook was more positive. So essentially, the timing issue between when the Scottish Fiscal Commission were making their forecast for the outlook for tax revenues, it was done in a more positive environment, and when the OBR were making their forecasts, which in turn was determining the BGA. And what we've seen since then is a significant revision up, both in the Fiscal Commission's forecast, but an even bigger revision in the OBR's forecast for income tax feeding through to the BGA. And that's essentially the driver of the net tax position. It's that's the negative reconciliation. It's that significant uplift in the BGA relative to what was in the budget, which is feeding through to the significant reconciliation we'll get into the budget for next year. And so we'll know the exact number later on this summer. It'll be a variation around 712 million, but our projection is that we've seen nothing to suggest that won't be a significant negative reconciliation that will hit the budget next year. And one of the challenges for the government is then how do they manage that, and particularly around limited constraints they have on borrowing and the Scotland Reserve. So we'll maybe pick that up in the conversation. And then the final thing just to say on the specifics of the policy of income tax policy is that we mentioned in the report this increasing divergence that we're seeing in taxpayers in Scotland relative to the UK, and which band they're in, which threshold they're in. Entirely deliberate. It's government policy to freeze bands and at lower levels in the rest of the UK. And of course, with growth in incomes, that's leading to an increasing number of people moving into higher tax bands. And you can see that perhaps most strikingly here. So we see an estimated increase in the number of Scottish higher rate taxpayers by about 70% since 2016, 2017, and an increase in the UK, but much less, more likely to be about 27% or so. So an increase across the UK, but much more prominent in the Scottish context, which is exactly what you should be seeing when you've got the policy decisions that have been made. So that's tax. Turning quickly to funding, what's the overall funding envelope looking like? If you look at resource spending is projected to increase, and it's projected to increase both in cash terms and also in real terms. However, once you adjust for the additional inflows of Social Security, which is driving a significant element of that overall increase in funding, and the growth that we're projecting in the non-domestic rates, then the amount essentially left for every other part of the budget, it looks much tighter than that, and that actually will be declining next year, and then starting to pick up at a much slower growth rate than overall totality of funding. So lots of more money is flowing in for Social Security because of high inflation uprating of benefits, but when you control for that, the amount of money for everything else looks much tighter. The position on capital looks particularly tight or particularly challenging. So we're projecting in real terms around about a 14% fall in the real terms value of capital spending over the next 5 years, in large part because of the planned reductions in the capital block grant, which feed through directly to the Scottish budget. Scottish Government can borrow additional funds in order to try and boost capital spending. There are constraints on that, both in terms of how much can be borrowed in any given year, and also the totality of how much can be borrowed in terms of the debt stock. And interestingly, again, one of the side effects of inflation is that the actual stock of that is actually declining in terms of real terms. The actual real spending power of that capital budget is declining over time. So that's the overall outlook for spend. The final thing just to run you through is the outlook for Social Security and what we're seeing around the projections there. And as you heard us say before, there's a couple of things which are quite important to think about and to focus upon. So Scottish Government is gradually taking on ever more responsibilities for social security in Scotland. So the rollout of adult disability payment, which started last year, previous year child disability payment, already things like Scottish Child Payment up and running, and further payments are coming in over the next few years. And in total, we project that Scottish social security spending by the Scottish Government will increase from 5.3 billion to 7.8 billion by the end of the forecast period. Now, again, a large part of that is coming through additional spending that would be taking place irrespective of devolution. So Scottish Government gets a block grant adjustment. This time it's a positive block grant adjustment to essentially compensate for the Scottish Government picking up social security payments that otherwise prior to devolution would have been undertaken by the UK government. And we see that rises from 4.5 billion in 2023-2024 to 6.1 billion by 2027-2028. So additional funds flowing in to pay for these social security benefits, and the overall funding rising as overall total spending rises. And one of the key reasons for that is rising inflation, so additional benefits coming through for that. We're also seeing quite an uptick, which I'll show you in a second, for some of the key benefits that Scotland has now, particularly in demand across the UK, particularly around disability benefits, where we're seeing an increase post-pandemic. But you'll see there that the gap between the two is such that the spending, so the green line, that the government is committing to do, we estimate is going to lie ahead of the funding that will come in via the block grant adjustment. We think that gap will widen over time. Again, that's entirely what you should expect to see. So Scottish Government is implementing new social security payments. There is no equivalent elsewhere in the UK. So things like the Scottish Child Payment. So that has to be paid for. That's additional spending than what is going to come through the block grant adjustment. And also changes that we think the Scottish Government is making to introduce a new approach to delivering social security in Scotland, particularly around things like disability payments. So the new approach, the new way of encouraging people to apply for benefits, trying to support them to achieve the full entitlement they are, moving away from some of the challenges around applications and applications to be a much more supportive and constructive environment for people with disabilities to claim the money that they're entitled to. But that will come with a cost. That will come with additional expenditure that will need to go on that. And that's the second element that drives up the gap between the two. As I said, one thing that's quite interesting is if you look recently, just one of the things which again perhaps related to post-COVID challenges, perhaps related to issues around NHS waiting times, perhaps related to issues around inactivity, is that we're seeing emerging evidence of an increase in demand for disability payments across the UK. So this is looking at essentially the applications per 10,000 people for working age disability payments, and you see that they've been increasing both in Scotland and the rest of the UK since around 2016. We're seeing some emerging evidence of a faster uptick in Scotland. We don't yet know what the reason for that is. Is that something that is unique or potentially related to the economy or related to the rollout of new benefits? Far too early to say here, but I guess the overall message is that we're seeing additional expenditure coming through across the UK for people who are demanding disability payments. And that's going to be, I think, one of the really interesting policy questions going forward about what are the causes of this and what can we do to potentially address this quite challenging situation where increasing people are reporting and saying they've got a disability, which is obviously really concerning for issues around inequality and public service delivery. And then just to really conclude, as I mentioned, we see this gap between spending on social security in Scotland and the amount of funding coming through. That's entirely deliberate. That's what you should be seeing, government policy to implement a different system. We think that will rise to about 1.3 billion by 2027, 2028, around kind of 600 million of that, so roughly just under half, being driven by these new payments in Scotland that don't have an equivalent BGA, so things like Scottish Child Payment, which is being rolled out and has very high take-up rates. And then the net position on Social Security is the second element, which again will add to just over half of that difference. And that's the different approach to delivering Social Security, which will increase demand, increase eligibility, increase applications in that context, which in turn will lead to higher expenditure. As again, some people referred to as a kind of a funding gap and things like that. I think it's really important to see this in the round of the totality of the budget. It's choices that government are making in order to prioritise certain elements of expenditure relative to others, but it does mean that money has to be found from somewhere in the budget to pay for that relative to other choices that could be made. Great. Well, I hope that gives you a broad overview of our latest assessment. What we're now going to do is turn over to Q&A. So just a reminder there, if you can go to slido.com and then type in that code, then you'll come into the Scottish Fiscal Commission page. Please do type in your question. You'll see other questions that are there that you can vote on, and we'll come around to as many questions as possible. Way to find out more about us, please look on the website so you can see all the reports, you can see all the data. So all the data that we use, we publish, you can access that. You can see infographics, etc. So please take a look around the website, and there's lots of really useful information there. And with that, what I'll do is I'll stop sharing and we'll move into the Q&A. Great. Okay, so couple of questions. So there's a question here. I'll maybe come to Domenico and Francis first of all. There's a question here talking about, are we out of the woods in terms of the risk of a wage price spiral? So maybe Francis, I could come to you first, and then Domenico. It'd be quite useful to hear from you, Domenico, as well, about any differences you're picking up internationally between what's happening in the UK in terms of prices and wages. But maybe Francis, I can come to you first. Do you think we're out the woods in terms of that spiral?
Yeah, no, I think that is still a significant risk. I think what we've seen is this funny combination where the original cause of this inflation, energy, is actually fallen back quite dramatically, and so it's no longer that. But we're getting these second round effects through foods or other things, and that sort of has a feeling a little bit of the momentum you get around a wage price spiral. We and others are not forecasting that to happen, but I think the risk is a significant one, and we and others have been surprised as to how big the second round effects been. So yes, I think it's certainly a significant risk, but not one that's currently in our forecast.
Okay, Francis, on you go, Domenico.
Yeah, sure. If I may chime in. So clearly we have to look at the recent evolution in inflation. It's true that the latest data was higher than expected. Was 8.7% in April, coming down from a peak of 10.7% in the last quarter of last year. So this is headline inflation. What we have seen is that wholesale energy prices have come down significantly to sort of pre-energy levels. Also, oil prices have come down as well, albeit not as dramatically. However, they've sparked sort of second-round effects in other items of the price index, and this is what we've been observing in the UK. By having a core inflation showing a certain degree of persistence. However, that's not specific really to the UK. We have been observing, similar dynamics, certainly in the Eurozone, where core inflation has shown to be particularly persistent. And, to some degree, this is also true in the United States. So this trend is not specific to the UK at all. However, what we are also seeing is that, generally speaking, headline inflation has been coming down. So this is something that really we observe internationally. And despite core inflation being persistent, the expectation is that it will come down. Clearly, will not sort of come down to a level, very close to the Bank of England's target. However, will still come significantly low. There is, of course, a certain degree of uncertainty, in when we make this forecast. There is no doubt about that. But I mean, this is important. This I think provides the background through which to answer the question of price wage spiral. So clearly, we have wages have grown at a level significantly below inflation. There will be attempts to sort of catch up with the erosion in purchasing power, no doubt. However, in a context where inflation will be coming down, I think it's difficult to argue that this spiral will sort of become entrenched, and this is really the danger that we sort of all wish to avoid. Thank you.
Okay, thanks, Domenico. And there's another question just further down, Francis. Maybe could you say a bit more about when we should expect to see a bit more about whether inflation is coming down as quickly as, say, ourselves, Bank of England, are predicting or hoping it will come down, and I guess what will happen if it doesn't, and when will they act?
Yeah. So I mean, as I said before, I mean, energy prices have come down, but I mean, you and I, when we're paying our retail energy bills, haven't really seen that yet because of the operation of what's called price cap, which effectively just draws out, slows down rises of energy prices, but also slows down falls as well. So we've got big dates coming up in July and October when we're expecting pretty large falls in energy bills, which I think most forecasters are seeing as sort of turning off the inflationary pressure somewhat and helping to ease that second round effect. So I think those events were quite important. And I think, as you've seen, even though obviously forecasters always say 1 month's numbers don't really matter that much, I think as you've seen in financial markets, that April number was a surprise on the positive side. So we're really hoping that doesn't occur again, because I think our forecast is based on those energy price falls in the retail sector really driving down inflation quite quickly in the coming year.
Okay, great. Thank you. So there's a couple of questions I might try and have a first go answer, and Domenico and Francis, you can come in as well, about the tax divergence between Scotland and the UK, and is there a risk of a tipping point where higher taxpayers move from Scotland, impacting on yield, etc. So a couple of things to say here on this. We in our forecast capture what we call behavioural effects. So we capture essentially how we think taxpayers will respond to changes in tax rates and tax bands, and we call them tax elasticities. And we look at average tax elasticities and marginal tax elasticity to try and get a handle on how we think the taxpayers will respond in that context. And the biggest change isn't actually, a lot of the time we talk about people moving to Scotland or moving out of Scotland and the like. Actually, the biggest behavioural change you get is much more about levels of effort of people in the economy. So how much people are working, how many hours they're working, they're changing the tax affairs, for example, incorporating. And those effects tend to be the ones which have the greatest impact, at least the highest impact, in terms of the behavioural responses that we do when we're doing our modelling, and that's the effects that essentially reduce it. So we publish the various static effects, so what the purely mechanistic, if you were to change the tax rates or tax bands, what it would raise, and then once we adjust for our behavioural effects, what you'll get. And particularly at the higher end of the income distribution, these behavioural effects can be potentially quite strong, and people have got the greatest flexibilities to change their tax affairs and change their employment income as a way to respond to these changes in the taxes there. So I guess that's the first point. The second point is that, that in terms of is there a tipping point? Again, that's something which is largely unknown. So clearly, in a way where you have an extreme world, we have an extreme world where essentially, that you retain none of your income and everything is by tax. That would obviously change your behaviours in quite a significant way. And if you're not going to receive any income from that, then you wouldn't work. However, The reality is about where people have a material change in behaviour and actually make big decisions about moving or locating is largely unknown there. And it's particularly unknown in a Scottish context because we're dealing with relatively new policy changes, we're dealing with relatively new data as well, and we will start to get a better handle on this over the next few years as the data comes in and is collected. And another thing is we need to bear in mind, though, in terms of we're thinking about the economic impacts of all of this, particularly when we're coming about our forecasting and we're doing our forecasting in the short term, increased taxes and taxing certain people more leads to a redistribution, and it leads to higher government spending elsewhere. So the net effect in the economy is, isn't necessarily negative because government is then spending more, or lower income households are spending more if it's going into things like social security. So the net effect there isn't entirely positive. But I think it is something which that governments across the world think about that balance when they're changing tax rates or thinking about freezing bans, about what's the net potential impact, both in the short run, but also in the long run in terms of how much revenue that they're raising. Because the end outcome is actually trying to maximise your tax take in order to invest in public services. So thinking about not just about your tax rates and bans, but thinking about what's happening to the tax base is really crucial. And it's a really difficult judgment call for governments, particularly at times where you've got high inflation and uncertainty in the economy for that. So it's something which we will be trying to report on. That's why we've got the charts in there about the growth in higher rate taxpayers and trying to understand about what point in the income distribution are people paying materially more tax. And in time, we'll start to be able to see, tracking these people, are we seeing their behaviours changing? Are we seeing changes in different flows of people between in and out of Scotland that we can then start to make, answer that question much more definitively? Domenico, do you want to come in?
Yeah, sure. Again, just to echo what you said, that clearly, there is a behavioral response, but this, applies especially to the higher tax bands. They're almost non-existent or almost irrelevant for low band taxpayers. However, reactions tend also to be slow over time. They don't happen overnight. And this is also one factor that we should consider, and that argues in favor of taking a sort of a more accurate measurement through time, as you noted, Graham. And clearly, tax policy is one component, not an unimportant one, but is one component of a broader range of factors that both households and corporations take into account. And then regarding the tipping point, at a certain point, of course, you do reach a tipping point, but clearly we are unable to observe it, and certainly it's not within the remit of the Commission. Thank you.
Great, thanks, Domenico. And Francis, we could come to you about capital spending, and there's a question about, is the reduction in capital spending not a major issue? And it's particularly with the current state of ageing schools, colleges and hospitals. And I guess we probably won't really comment too much on the state of the capital stock and whether that is good or bad and what the implication might be. But from an economic perspective, the effects of capital investment, government capital investment on the economy, good, bad and indifferent. Maybe could you expand on that, please?
Yeah, I think the evidence is that public sector investment, obviously well directed, is beneficial to growth. Clearly, sort of white elephant projects, not so, but a general principle, public sector investment is important for stimulating private investment and the economy generally. And obviously, there are different routes: education, transport infrastructure. All those things are important. So it can be a concern if that level falls too low. And I think, as we're seeing now, almost inevitably in a period of where money is tight and the budgets are tight, across the world, really, well, almost across the world. I think maybe the United States is a bit of an exception. We are seeing public investment being cut back somewhat, and so that might have long-run implications for economic growth.
And maybe if I could just build on that, Francis, make the point, there's another question there about social security and the potential economic impacts of that over the long run. And the short answer to that is yes. And you would hope that increases investments, particularly to tackle inequality and particularly to tackle poverty, should in the long run help improve things like participation, help improve things like productivity of workers, etc., over the long run. One of the challenges is measuring that, and for academics who look at this stuff, it's really tricky to track that all the way through and to put a definitive number on it. But yeah, the evidence that is there would suggest that actually tackling inequality and tackling poverty at the source does lead to long-run economic benefits, not just for the individual, but for the economy as a whole. Just one thing, just to say about how we do it in our modelling, in our forecasts in the 5-year period. Essentially, because these benefits are so long, we are essentially, it's largely, we don't capture these. We're simply, it's levels of government expenditure that feed through to the totality of the economy there, because many of these benefits are very longer term. So the forecast horizon is money in and money out in that context. It is something which we will intend to look at much more detail in our long run fiscal sustainability work, which we kicked off in March when we're looking at demographics and costs in public services. We'll be looking at climate change quite soon, but thinking about inequalities and what are the costs of not tackling inequalities for the public sector, but also what are the potential revenue benefits and economic benefits for tackling some of these wicked problems. What might the effects be on that? Domenico?
Yeah, just if I may come in on the issue of social security, I think when we consider social security spending, especially in the current context, we also need to consider that low-income households have been especially affected by rising prices, by inflation. Clearly, low-income households cannot cut on their savings. Cannot draw on their savings to cope with the rising prices, cannot cut discretionary spending, maybe because there's no discretionary spendings for many of these households, and therefore, in a way, the impact of rising prices have been uneven and have especially hit low-income households and people more than other segments of the society. This is just to bring a bit more balance to the issue of social security and the increasing spending that we are forecasting. Thank you.
Okay, that's great. Okay, there's a couple of just kind of factual questions which I'll just try and get through quite quickly, just so we can then spend the final time talking about some of the bigger questions. There's a question there: do the income tax forecast take out a potential behavioural change, people moving on to pensions? Yes, exactly. And that's the issue I was talking about, that behavioural change doesn't have to be leaving Scotland or coming to Scotland. It could be changing your tax affairs legally into different activities, so changing money to pensions, incorporation, changing types of work. So there's issues there that can happen. If they're changing UK government and they start to implement new social security payments, might that to help tackle poverty and the economy, will the benefits gap get less? So yeah, so if the UK government choose, for example, to significantly increase benefits that have a block grant adjustment, for example, in the rest of the UK, that will feed through to additional spending in the Scottish budget. It's then up to the Scottish government to decide what to do about that. So you kind of say there, will the gap get less? So the difference would potentially get less. However, if they were to choose to add to these packages or introduce equivalent packages, depending on what the UK government did, then obviously that would be new spending commitments that would come down the line. So additional spending would potentially flow through. Of course, if it's benefits that are not devolved and actual benefits that are directly still reserved, that will come through to the individuals in Scotland, but it won't come through directly to the Scottish government budget. And then there's a question there about living standards going back to 1990 level. Now, what's saying there is that living standards essentially have fallen at the fastest rate since 1998. So it won't go back to the level. It's essentially going back to where they were, relatively a few years ago. And it'll take about 2 or 3 years yet for them to recover to where they were pre-energy crisis. So it's the relative change that has been the biggest that we've potentially seen. And then there's a question there about given wage increases, will we see variation to the thresholds and higher rate top bands? Obviously, it's a government choice about what they do about high rate thresholds and top rate bands, etc. But all else remaining equal, if you have relatively high inflation, and as the UK and Scottish governments are doing, are freezing essentially the thresholds, then more people will move into these thresholds simply because of the wage growth, and that's the effects that people call fiscal drag, and that would normally accelerate in times of inflation, and if you're freezing thresholds, it will increase even more. Okay, so the question, if on EU exits, I'll give this to you, Domenico, and there's a question there about results of EU exit, but are EU countries doing any better than the kind of UK and Scotland in that context? So maybe if you could give us a bit of with your experience, a bit of an international flavour to the economic outlook just now, please.
Yeah, sure. There is within the EU, there is always a tendency to sort of to attribute to the EU membership whether things are going bad. So not just as good, but also bad. Clearly, the experience of many European countries is different. There are some countries, Ireland has been doing extremely well. Other countries, like Italy, for instance, have been struggling. There is a tendency to attribute the source and the cause of this struggling to the European Union, to the single currency. But the reality is that clearly you have also to adjust in order to profit from opportunities, from a changing context. Even if you were outside of the EU, the world economy has been changing. There's been a lot of structural changes, and some countries have been slow to react. Those who have been sort of more opportunistic have been able to reap the benefits better and more than others.
Great, thanks, Domenico. And I saw a chart today just about the differences in inflation rates, which are quite interesting across countries, and some countries perhaps ahead of where we are in the UK and having much lower inflation rates. And
no, absolutely, Graham. That's very true. If you look at the inflation rate in Spain, it's close to around 3%, or very close to the ECB target of 2%. If you look at the inflation rate in Italy, is much higher, not to mention those in the Baltic economy. So there is a lot of heterogeneity, and this also highlights, the structural challenge of policy making in the Eurozone, where you essentially have to make policy choices that are common to a mix of structurally diverse economies.
Mm-hmm. Great. And Francis, a question here about, do we consider external international events that may impact on the calculations, further conflicts, escalation of current conflicts, US election? And I guess one of the things I mentioned there was the reopening of China more quickly, which I guess was a positive risk on the upside. I mean, could you just explain a wee bit about the process of how we make our forecasts and the kind of risks and uncertainties that exist around that?
Yeah, I mean, I think obviously, it always forecast as a central view, which usually is one which doesn't have some, low, high problem but low risk event in it. So it is true that inevitably with the forecast, surprises are not already in the forecast, and even ones you might have said, there's a small risk of escalation of war, that sort of thing. The forecast is still the central tendency we go for. So yes, I mean, we'll always consider those risks, but we won't. They only become central when they're considered to be the most likely pathway. In terms of the international impact, I mean, that's figured in both. Obviously, with very often they're very similar to the UK and to Scotland, and so I think one of the things we have to think of very carefully when we do our forecasts is what are the differential impacts of an international event for Scotland versus the rest of the UK, and that's a big part of the consideration, because very often, as I say, that'll be similar, and as we've seen with the way the fiscal framework operates, shocks to both UK and Scotland. If the framework they wash through the framework, generally speaking.
Yeah. And that's the key. It's the difference, isn't it? The relative difference. And we made that point in December that actually in areas such as house prices, for example, we think that they will decline in Scotland, but we because of the softening in the economy and the increase in interest rates, but we think that'll be more of a decline in the rest of the UK because higher indebtedness, etc. So it's that relative bit that's really crucial. And then whether a global shock, as the questioner mentions, has a more disproportionate impact on certain sectors in the Scottish economy. So again, the energy price shock is bad for most of the economy, but it's good for parts of the economy that are tied to oil and gas, for example. And we've seen all the profits of the companies go up, and that feeds through to earnings and the like. So the relative marginal piece is really important there. And that kind of gets into one final question, which is the point about what happens if you don't have London and the South East in these projections for the rest of the UK or for the UK as a whole. And we do know that over the long term that the gap between London and the South East and the rest of the economy has widened. So over the last 10 to 15 years, or actually even after the financial crisis, we thought that might have a more disproportionate impact in London. London has grown faster than the rest of the UK economy, and the gap has widened there. For us and for the Scottish budget, it's not really important if London and the South East are in there. I can understand there's a big economic policy question in that, but for the purposes of the budget, what really matters is the rest of the UK, because London and South East are included in the block grant calculations, so they feed through to things like income tax and land and building transactions tax. So unfortunately, like it or not, a very strong growth in London makes the challenge of matching that tax performance in Scotland more difficult, because that's included in the driving factor that increases the block grant adjustment. Right. Okay. So I'm told it's good Teams and Zoom etiquette to finish meetings just before the hour, so that gives everyone a chance to go and have a cup of tea or stretch their legs before they go on to their next meeting. So let's follow through on that with this meeting. Can I just, first of all, thank my colleagues in the Fiscal Commission for all the work and support for organising the session today. And can I thank everybody else for, first of all, the really thoughtful questions and really interesting questions that you've given to us, but also to taking the time to come along and spend some of your valuable time with us chatting through our latest forecasts. Things to watch are things like information coming out over the summer. We'll know a bit more about that, and then we'll be getting ready for our forecasts that will underpin the budget later on in the year, and we'll do more updates on our fiscal sustainability work as well. And until then, can I just say thank you very much for joining us, and yeah, just look forward to seeing you all at a future Fiscal Commission event. Bye, everyone.
Thank you. Bye-bye. Thanks to everyone.